Hi, this is Professor Nugent, and this is a wrap-up of round one of the simulation. So you can see here, I'm just going over the charts pages here, and you can see here that everybody made profits. Now this is very good. So every company has made profits. If we go through all these companies, we see that overall everybody was able to make the decisions and put together a company for this year that made profits. If we look at the points, and I'm going to go back and explain the points, how they're accumulated and how they work in a minute, but we could see that this team here earned 985 points just in one round. Remember, you need 3,000 points to get all the points for this project. To get the full score for this project, you need 3,000 points. So here's a company already has 1/3, and they have 6 rounds to earn these points. In the first round, they already got almost a third of their points put together here. And we have a team over here that did 915 points. A couple of teams here with 800 points. Anybody over 500 points did very well. And here's the 400 point mark. So about here, just about, I would say, everybody except for about 6 teams scored over 500 points. And 500 points is the is doing very well. So if you made 500 points or more, you're doing very well and you're on track to get the full grade for the project. If you scored under 500 points, I'm going to give you some hints and some tips for everybody to perform better. And but overall, I think most teams, most student teams here have done very well for the first round. Okay, so if we see in stock price, 212 Motoring had the highest stock price at $17, while Frank's Autos came in at $8.23 towards the bottom. Uh, but everyone's stock price did improve, so no one went down in stock price. The same thing with sales. Everyone's sales improved. Here's one company where their sales were the lowest. I would say to them, you need to read the student user guide because they spell out for you quite clearly how many units you're likely to sell every round, give or take a few hundred based on how you put your round together. But the user guide does a really good job of explaining how much you could sell. So here, the top team, RMT Motors, sold 263 million dollars worth of cars. Sometimes I get this question, Professor Nugent, I had the number one sales. How come how come I didn't have the number one points or I wasn't the best team? And I usually say to them, listen, I have two companies I want to sell you. One company has $1 billion in sales. One company has $100 million in sales. Which company would you rather own? And they usually come back and say, I rather own the $1 billion company. And then I say, well, the $1 billion company has $500 million in losses a year. And the $100 million company has $80 million of profits a year. Now, which company would you rather own? So it's not necessarily, see the point? It's not necessarily about who sells the most. It's about who makes the most profits. That's the name of the game. It's profits. Sales are nice, and sales do turn into profits. But just imagine a company. There was a company called Buy.com that was competing with Amazon, but they were selling. Their idea is let's sell everything at a loss and we'll make the money back on advertising. Well, advertisers never really made up the difference, and the company went out of business and delisted. It was later repurchased, and I'm sure there's a history there. But they never became the Amazon they could have because they weren't focused on profits; they were focused on sales dollars. Okay, we look at earnings per share, and again, we have 212 Motoring has the highest earnings per share, and notice they also have the highest stock price. So, you know, earnings per share is what investors like. And we had, I think, we had two companies, three companies. Everybody started out at $1.90 a share. So we had three companies. No, actually, just one company that was less than that. These other two companies, $1.89. Everybody else was able to increase their earnings per share in the simulation. So overall, teams performed adequately. If I look at the company rankings, we see here, we see here that the current round we had three, four companies, five companies that did 800 points or better. That's phenomenal. That's really top scores, and you're almost a third of the way there for the total points you need. And then we had a range all the way. Now, remember the company that had very poor sales, they also had very poor points because um, their profit margins were low. So so we have a big range here in points earned. Now, remember, anybody who earned over 500 points is doing very well. And we could see here that the majority of the class earned over 500 points and did very well. And that's excellent. Now, if you did less than 500 points, don't be too upset because a lot of the points that you lost, you can earn the next round as long as you put things back on track. You'll get, since they're year over year points, you'll get those points back. And I'll explain a little bit later how that works. Now, as far as gross profits, a couple companies here were able to greatly increase their gross profits. Now, this leapfrogged them ahead. Now, their gross profits, everybody, if you noticed, all companies started out at 40%. And I said that in the starting video on how to do the simulation. If you take the gross profits divided by the sales for year zero, the companies were starting out at a 40% profit margin. So every company that was able to increase their profit margins, that was good. That's what investors like. Investors never like it when profit margins go down. So all these companies here were able to increase their profit margins. These companies here were able to get them from 40 to 50%. And this percentile score here is a rank of comparing your performance to, I think, about 700 other games and about probably 5,000 other students. So these companies here, these three companies here, perform better than 90% of all the teams and students who've ever played the simulation, which is really excellent. I would say anybody who performs at a 50 percentile or higher is doing really well. And we have majority of our classes at the 50 percentile or higher. And this just ranks, sort of like a GMAT score. What percentile do you fall in as far as your performance compared to everybody else that played this game? And you can see that we have a good range of stock price as well. And it's stock price reacts to profits. And you can see that 212 Motoring, this company may not have earned the most points for other reasons, but they're pretty high up there. But their profits definitely translated into an increased stock price. Okay, so this total points section, this will change as we go into new rounds. We have another round due on Friday, and this will add this week's points to next week's points, and you'll see this constantly being increased. So this percentile here doesn't mean anything until we get to the last round, so don't worry about this one here. Return on equity, this is just looking at the amount of stock that was put into the company and the return compared to the returns you've got. The operating profits, okay, so the gross margin profits are just cost of goods sold and sales. Calculates the gross margin, and that would be the gross profits divided by sales. The operating profits divided by sales would be the operating profit margin, and you could see that we had a nice range in here as well. We have our earnings per share, and typically this will look very similar to our gross profit margin line, and we could see that it depends on the sales, but basically you need two things to have a high earnings per share. Profits is one of them, and then also the amount of outstanding shares. Some teams repurchase stock, and that shrunk the amount of outstanding shares and helped boost up their earnings per share. Return on assets, some companies purchased a lot of assets, a lot of plants, equipment, a lot of investments in the company. So your profit margins compared to the amount of assets you have, the bigger your asset base, the harder it is to get a higher percentage return on those assets. You're looking for those assets to make money. So, for example, if you were going to open up, two different ice cream stores, One ice cream store is just freezers and scoops and buckets of ice cream. It costs you, maybe $20,000 in assets to open that store. Another store is all fancy. It's like a Red Mango, fancy soft serve machines and a bunch of fixtures and tables, and that maybe costs you $100,000 to open up. So if you look at the the assets of the two companies, one is 5 times more than the other. If 20,000 versus 100,000. Now, if they both make, $200,000 in profits for the year, who has a better return on the assets? For the first company with $20,000 of assets, they have a 10 times return, or where the company who had $100,000 in assets, has a 1 times return or 100% return. The other company has 1,000% return. So that's what we're looking at there. So if you go ahead, you buy extra plants that you don't need, or you spend heavily on assets, or you have a lot of leftover inventory, it's going to affect this return on assets. Okay. So the net profit margin is, this is after we pay for all operations, interest, taxes, and we have our net profit margin. Then our sales per revenue, and you can see that, which is the sales revenue per share. So we take the total sales divided by the outstanding shares, and you can see that, the mix of companies here are quite different. Where we had 212 Motoring at the top point, top margin and earnings per share, they didn't necessarily have the top sales. So they were able to sell fewer cars but more profitable cars, and that made a big difference. This game is not about who can sell the most, it's about who can make the most profits. Okay, so this is kind of looking at that. Now let's talk about some team strategies and some ideas to help people do better. So if you feel you didn't do well in a round, I'm going to go in and give you some tips and some ideas about how to make things better. Okay, so here's a company that's one of the companies playing in our game. I'm not going to necessarily say who this is, but we want to look at the overview points. So your first question should be, how are these points calculated? This company earned 294 points. Now, it's a year over year percentile. So Y over Y means year over year. So we have year one, $18, and year zero is $12. So this is, a $6 increase. So you go from $12 to $18. That's a 50% year over year change. You get 50 points for that. And you can see at this company, now their quick ratio went from 4 to 2. Now with the quick ratio, if this actually declines, you had a 49% decline, so you're going to lose 49 points. The only ratio, which is kind of the opposite, is the debt ratio. If the debt ratio goes up, that's a bad thing. So this debt ratio went up 14%, you lose 14 points because you don't want your debt to increase. Gross profit margin. So this company went from 40% to 38%. You can check any stock. If a stock comes out with their earnings and they say our profit margin slipped 2 percentage points, that company disappointed and their stock is going to be decimated. So you can never let your profit margin slip. So this is something you have to focus on. If this company's gross profit margins are 38%, when you go into next round, you have to make sure that your percentage is higher. And you should always aim for your gross profit margins to be 2 to 5% higher than the previous round. Okay, so the operating profit margins also declined from 23 to 20%, so that's a 14% decline. And then the net profit margins also declined. Now, for the operating profit margins, the big key thing here that people have to watch is their advertising budget. If they overspend too heavily on their advertising budget, they may squeeze lose a lot of the operating profit margins in an overly inflated advertising budget, and that's why that could shift from round to round. Okay, so the equity multiplier, the return on investment, we could see that they were able to actually increase this by 36%. The return on equity stayed flat. The earnings per share went up 25%, so they got 25 points there. The return on assets we had 25% in year zero, 18%. This company I'm thinking this company had a lot of leftover inventory that inflated their assets, and that's why they lost 28 points here. If we look at market capitalization, we see that the stock price, the value of the stock overall did increase, so they got 100 points there. The book value of the stock increased. The book value is simply assets minus liabilities equals equity. You take the equity divided by the amount of outstanding shares, and that's your book value per share. This is all these ratios that they talk about here are all detailed, and the formulas are all given in the student user guide if you're curious. And they were able to increase their book value. And their forecast, everybody starts out in year zero with a pretty terrible forecasting rate of 65%, meaning that only 65% of the cars that you said were going to sell sold. Here, the forecast, you sold 95% of what you said you're going to sell, so you definitely had leftover inventory, 99, 99, and 96. And you earn a significant amount of points because your forecasting did improve, but if it's anything less than 100%, you may have had some leftover inventory. Okay. I'm going to check that though. All right, so here they invested. Okay, so this could be why. It may not be an inventory situation here, but it looked like they invested heavily in their operations. So they earned 100 points for that, but they had a deficit, a cash deficit of 15 million, which lost them 100 points. A lot of teams will say, a lot of students will say to me, what happened here? I had a surplus and now it's a deficit, and something's wrong here, and this simulation's broken, and I'm all mad, and this isn't working, and I'm very frustrated, and I'll say, well, calm down. What happened was if you saw that you had a surplus and now that you have a deficit, you must have cars that you didn't sell that you forecasted to sell. So if you have leftover inventory, that could be the issue. Okay, so why this combination of key financial ratios? This is what banks, outside investors, stock investors, private equity, basically, if they're going to analyze a company, and I was a financial analyst, so I know if you're going to analyze a company, and I was also a credit analyst at one point, and you're going to look at a company and say, should I invest my money with this company? Do I feel this company is good? This is what you definitely want to look at. You want to look at their revenue, their quick and debt ratios, their profit margins, their asset utilizations, their earnings per share, return on equity, their forecasting ability, their book value, how they invest, their operational, how they invest to improve the company, whether they're maintaining cash surpluses on their budgets. This is definitely all stuff that analysts, anybody looking in the company that's judging the company, look at. And the way you judge a company is how they improve. And if companies improve from year over year, like this indicates a year-over-year improvement or decline, that's generally what you're judging. Just like I would judge you as a student. If you come to me with A grades in one semester, and the next semester you have C's, I'm going to say, what happened? This is bad. You're doing bad. But if you're a student that has all F's, and the next semester you have all C's, I'm going to be like, wow, you're doing fantastic. This is great. Let's see some C pluses and B minuses next semester. So it's all about this constant improvement that companies must have. So the focus on the game here. Okay. So definitely when you're moving forward, one thing that can help is if you look at these individual charts. They plot, so this company, they actually were able to increase their sales and they were able to increase their profits. Which is good. And you will see that their stock price and their earnings per share went up. And here they had their market potential and their actual sales. This pink area is what you actually sold. This blue area is your market potential. So they actually sold every car that they made. So they didn't have any leftover inventory. So they must have had a deficit going into the last round. But let me just double check that. No, they did have leftover inventory. Okay, so this makes sense. So this is how you can check if you had leftover inventory, and it makes sense because on the other charts page that we're looking at, you could see that the company they sold everything. they met all of their market potential. So if the market was demanding 2,082 cars, they sold 2,082 cars, which means they could have had some leftover inventory. And I think that is, definitely something that happened here. Okay, so in the production department, we see that they had this leftover inventory. So that's how that surprise deficit occurred, because think of this, you have 300, 400, 500, almost 600 cars not sold. So if you have 600 cars that didn't sell, 600 times, $30,000, you're talking about a lot of unsold inventory that now is bloating your assets, which is going to lower your return on assets. But more importantly, these cars are not going to contribute the profits that you thought they were. And, if you're talking about, 600 cars and maybe a sell price of around 30,000, that's $18 million of cars. And if you have a profit margin of 25%, say net profit margin, you're talking about $4 or $5 million that or more that you're missing. So you got to be careful on the forecasting. Although I don't think this forecasting is so bad. I think this is actually pretty good forecasting. You just need to keep more of a surplus on your finance department. So that way, when you if you do run into some unsold inventory, the surplus will cover whatever unexpected profits you don't have, and therefore you won't have an unexpected deficit. Okay, so here's a different company in our competition, and you could see they have sort of the opposite problem. Their actual sales, and they manufactured and sold 1,850 cars, but the demand was 2,200 cars. So this company has the opposite problem, where they were under forecasting and under producing the cars they needed. So here, and this is just right here in the luxury, 1,350 cars were actually sold, and that was everything that they had made and forecasted, but the demand was 1,777. So this is a case of someone should really definitely read over the user guide, because in the user guide they show that, I think you sold maybe 1,500 luxury cars in year zero, and if there's a 35% increase in the market, you have a potential to sell 1,900. So the forecasting so if you see this where the pink is very low below the blue, you're under forecasting yourselves and really shrinking your sales. So that's a situation I want teams to really look at this individual charts page and go to the bottom and see what your demand versus actual is. And so for this company, don't work off this pink bar. When you're going to do your forecasting for next round, look at this and say, okay, 25, 55. The sedans grow at, I don't know, maybe 25%. So you got to figure, I should be forecasting anywhere from 2,900 to 3,300, depending on how well I built my car and how well I think the car is manufactured. So people need to keep that in mind, when they're forecasting. Forecasting plays a big role in this simulation, and I see, students do have a tough time with it. The user guide gives you really good clues about where you can expect the market to be. And it's really up to you to fine tune it, plus or minus 300, 400 cars on either side of the and it's all depending on how much advertising you're spending, how good your car is. There's a lot of factors in play here, so it is tricky. And it takes a while. That's why the practice game is good. If you can get in that practice game and you can run a few rounds, you can run all the way up to round 6, restart it. You can restart it at any point. I think if you look at the bottom of the overview page, there's going to be a link that says restart the practice rounds, and you can go in there and just keep trying to play your ideas out and practice to see how it works and see how to get those scores that you're really looking for the class. Okay, so here we are. This is my individual practice where I'm in round 1, so I want to simulate what might have happened to a lot of students. So in my simulation, I over forecasted some cars and overproduced some cars so I could show you that inventory, what's going to happen here. And okay, so here's last year's financial statements, and this is next year's pro forma. This pro forma financial statements, which I hope you remember from your accounting class or maybe even your finance class, these are an estimate based on your forecasts. If your forecasts are not completely accurate, these estimates will not come true. So this is not written in stone here. This next year pro forma, this is just an estimate of what could happen if you sell every car that you've planned to sell. So you can't look at this and say, if you don't exactly see the same numbers after the round is processed, that's not the point of this. This is just a rough estimate. Hopefully, if your forecasts are really tight, you'll see something similar, but it's not a guarantee. Last year's data, this is how I came up with, if I took the 48 million divided by the 121 million, that's how I got my 40% profit margins. So when I went in to do my game here, I made my cars. I had a 39% profit margin, which is no good. Investors would be disappointed. So I'm going to go ahead and lower my horsepower, since they don't really care about horsepower too much in this car, to get my 45% here. And then my sedan class is 37, so that's no good. So I'm going to lower a couple statistics here. And now I'm over 46, so that's what I'm looking for. And the truck is at 45%. I think I can do better. So I'm going to lower some ratios here. And I'm over forecasting on purpose because I know I'm not going to sell 2,000 cars, because I want to show you how I can go from surplus to deficit. And my luxury class looks good. So, and don't forget to fill out your reflective observations on the team competition. So I'm going to submit my practice round, my marketing. Now in my production area, I'm buying a lot of plants, and I'm producing a certain amount of cars, and you always want to have excess. The excess or shortage, I want to have zero here, because if I'm trying to play a game where I'm going to build more cars than I need, and I'm going to have an excess, these extra 200 cars aren't going to be reflected in the sales in the pro forma. Only thing that's going to be in the pro forma is your forecasted sales. So if you're going to try and produce more than your forecasted sales, then your pro formas will not be correct. So you always want to have this be zero here. It's sort of a guideline. Now, I'm investing in 2 levels of new technologies for each of the cars, costing me $4 million. And you'll see where the savings comes into play. Not this round. So if I go to my sales department this round, you can see that my operational cost reductions is 0. We'll see what happens next round. Okay, so I'm in my finance department here, and look, I have a $13 million surplus. So maybe I'll buy back some stock with some of my surplus money. So now I only have a $3 million surplus. So it says I'm selling $280 million worth of cars with $71 million in profits and a $3 million surplus. So I'm going to run the round. This is my practice round. So I'm going to run that. And I'm going to go right to the finance department. And I'm going to see here that now last year is actually year 1, because I'm in year 2, which you can see up here. So I have 238 million sales. I was supposed to have 280 million. What happened? I have only 58 million in profits. I was supposed to have 70 million. And I have a deficit of 26 million when I showed a surplus of 3 million. So what happened? Well, obviously, on the production side, I had a lot of unsold vehicles. And that's what created this unexpected deficit that you may have experienced too and are questioning. If I go to my sales department, you'll see that I have those 2 levels I bought for each of my cars are now in place as an operational cost reduction. So 2 levels, each level is a cost reduction of $300 per vehicle. I bought 2 levels, so that's my $600. So when I go to make this car now, my new model of the car. Now, the customer expectations, you'll notice that these ranges here for the customer expectations, they increased because every year, because people want more. They want cars that have better gas mileage, better horsepower, more safety features, more luxury features, better warranties and months reliability. Months of reliability is the length of the warranty. So if you look at cars from the 80s to cars today, there's so many more safety features, luxury features, better gas mileage, more horsepower. Engines have evolved because consumers are always expecting that. But they're not willing to pay, that much more for the car this year than last year, even though you made all these improvements. So when I build the car, you could see here that, 4,008 and about 9,000 here should be, $13,000. But since I have a $600 reduction, it's only 12,400. So that helps me maintain my profit margins. But it gets trickier because as the customer expectations increase, it gets harder and harder to make that car that you want to make. And then when you start building your car, you may be getting to the lower and the bottom end of the customer expectation range, and that's going to affect your demand for your car. So it's a delicate balance here on how you make your car. Now this would just simply won't do. If my profit margins were, if I look at my overview points, if my profit margins last round were 51%, I can't be making vehicles that are going to be lower than that. So I might have to sacrifice. There's only so I can't go too low, but I'm probably going to have to sacrifice in making this new vehicle to try to meet those profit margins because I didn't invest heavily enough on. Okay, so I was able to get it to 56, but I'm building a significantly less a car that's meeting the customer expectations at the lower level, and sometimes below the level, and a higher price. So I may not get as much demand potential as I had in the previous game. All right. So if I go back to the overview points, we can see here I still did very well in my overview points, even though I had a deficit. I was able to greatly increase my revenues, but my total asset turnover is negative. I lost 8% of my total asset turnover. That's because I had all that extra inventory. Overall, I did fairly well, although you can see how if your forecast is anything less than 100%, I know I have unsold vehicles, which is, not a great thing. So I'm losing points on my forecasting because I over forecasted, had unsold vehicles, and I'm losing points on my return on assets. And I probably could have, all my multiples would look better if I, especially the return on assets of the total asset turnover, this is the total asset turnover, and then my ROA, return on assets, both of these would have been a lot better if I didn't have the unsold inventory. Okay. Now, once you're in round two, like everybody's in round two now, you do have this charts page, which I went over before, which will show you how you're doing in your charts, and you have the advertising to see how different companies, your competitors, advertise for last round, and you have the industry charts, which I went over. This is not our industry. This is my practice game because I want to give you an example of which is common for a lot of the teams. Now you also have this new industry page. This industry page outlines. There's really no secrets here. So even if I'm going over the simulation and someone's team appears in this review I'm doing and their name appears here, not your personal name, but your team's name, which no other student knows who's connected to what team. So there is a privacy here. But in the industry page, you could see for last round, for all your competitors, how exactly did they make their vehicle, their market potential, their price, all their statistics, their key financial ratios, and their key financial information is all here, and their points. So this is something that you could use to go in to see, okay, I didn't do well. How did other people make their cars, and what decisions did they make that led them to develop a car that was so profitable? So you'll get, and this is exactly how it works in the industry. If you want to know, you may not know what cars Ford is making next year, but you could definitely go down to the dealer room or online and see all the specifics of how Ford is manufacturing their cars. You look at their annual reports, you're going to get all the financial statistics and ratios. So this is similar to what you'd find in the industry. So I would encourage you to go into this industry tab and see, a team that did very well, how did they make the car? Maybe they can get some ideas there. And that's something auto companies do to each other all the time, so it's not considered cheating at all. Your financials are backed up on the financials tab, so each year your financials will be overlaid in here and be backed up, so you always have a copy of them. And then basically the simulation just starts over. So now you just work in round two. What's different in round two is that the customer expectations are higher. You may have some cost reductions, and you also get an indicator of what you sold last year. So you have to kind of start the process all over again, and you have to re-answer the reflective observations. And then the same thing for the marking. Your advertising, the two boxes in advertising will carry over from round to round, but the third box you have to write for me new. Production department, again, the reflective observation boxes are open there. And you want to do a good job on these reflective observation boxes because I'm going to give extra credit at the end of the simulation, whoever fills these out the best. Okay, so that's the end of my review of round one for the class, and I hope this was helpful to you. Remember that you feel free to email me if you have any questions about the simulation. Join me on my Wednesday office hours, which are from 1 to 2 on Wednesdays. You just log in by clicking on Stony Brook. Uh, well, actually, I'm just going to go and show you how to do this. When you're in Blackboard and you're inside the class, when you want to come to my online office hours, you just click this SB Connect button here, and you'll join me in my online office hours, and you can type to me, text message me, you can talk to me if you have a microphone, and I can show you my desktop and help you answer any questions you may be having with the class. Hopefully to get that to run more smoothly. Anyway, I hope this has been informative and we got a better idea of how to proceed forward. And I wish everyone the best of luck for the next round, which is due on Friday at 11:30 p.m. And I'll see you in class. Take care.